Good morning. Mark Ostwald from ADM Investor Services International. And this week I'd like to look at something which is rather longer term in terms of market influences. I would stress that this is probably not something which is going to be the cause of the next downturn. However, it will be heftily impacted during the next downturn, and it's therefore something that we do need to pay attention to. It's inspired effectively because we've had the Federal Reserve's Financial Stability Report, which it publishes semi-annually this week, and in which it highlights risks to the financial system and what potential hazards that there are out there. In this particular issue, as in the November issue, they have been pointing to the rapid growth in global debt. And obviously that rapid growth, as one can see from the chart, has been enormous. We haven't actually been in any form of debt consolidation following the global financial crisis, but rather seen a rapid growth of about 70 trillion. It stands at something in the region of 240% of global GDP, and per se is at a stage where we realize that this is probably not even in emerging markets going to be something which eventually gets paid off, but will eventually have to be written down. The Fed's Financial Stability Report basically points to a great deal of comfort that there hasn't actually been, there aren't many risks sitting on the bank balance sheets. But if we look at the next chart, I think really what it emphasizes to me, and this is from SIFMA, the US Bond Market Association, as once was. It highlights basically that the growth in debt now is basically all, basically any form of borrowing which goes on, any form of funding which goes on for in financial markets is pretty much totally and utterly concentrated in the debt market. This despite the fact that actually the distribution in terms of outstanding issuance as opposed to new issuance is still roughly about 50-50. The Fed noted that there were valuation pressures which were elevated in a number of markets. It noted that above all, there's borrowing by businesses is historically high, and that sadly the most rapid increases in debt are concentrated amongst the riskiest companies amid signs of deteriorating credit standards. Therefore, we are in a situation where we need to be actually very wary of this. And this is where the third chart, which we've got here today, about the rapid growth in collateralized loan obligation issuance and the huge take-up by both ETFs and mutual funds of this collateralized loan obligations, or it's basically pooling leveraged loans, looks uncomfortably similar to the rapid accumulation that we saw in CDOs of subprime ABS before the global financial crisis. So we are in this situation, as Bank of Canada Governor Wilkins noted, that what we really need to be concerned about is we don't know how a lot of the funds, for particular ETFs, will act when we get an adverse shock, and how the associated portfolio flows will evolve. As Mrs. Wilkins noted, her concerns primarily center around the amplified contagion risks due to herd behavior amongst ETF investors. So this is something basically we need to pay a good deal of attention to, and particularly if we see a breakdown in US-China trade talks and the threat of a global recession, it's something that will be front and center for financial markets.